And so, everybody, welcome to our last session today of the manufacturing and materials track of Startup Week. We are very fortunate to have with us today three very experienced entrepreneurs and venture capitalists. They're going to give us a little bit of insight into what early stage venture capital looks like. So I'm going to take just a second and introduce them all, and then we're going to start in a roundtable here. We'll do it alphabetical order by first name, so there's no preference, starting with Bill. So Bill Baumel is a seasoned venture capitalist who spent more than 20 years investing in Silicon Valley before returning to his home state and to start the Ohio Innovation Fund. His investments include SaaS, data science, cybersecurity, medtech, biopharma, and cell and gene therapy. Bill is recognized as one of the top 10 venture capitalists in the United States based on a successful track record, which includes 4 IPOs, 1 IPO scheduled for Q3 of 2020, and 10 major acquisitions by Dell, SAP, Medtronic, Intuit, Stryker, and others, ranging from enterprise value to a few hundred millions up to over 30 billion. At OIF, Bill works in the trenches with Ohio-based entrepreneurs to rapidly scale their companies and build the industries of the future. Bill leverages key Silicon Valley growth principles of big thinking and moving quickly, and applies them to Midwest grit, determination, and capital efficiency, driving the creation of globally competitive companies. OIF companies have secured the majority of Fortune 500 as customers, and their strategic partners include Microsoft, Intel, SAP, Signify, Genentech, Facebook, Citi, Dell, AFRL, Nationwide Children's Hospital, and Dalmar, among others. Bill serves on the boards of the following IOF companies: Aware, Clarimetrix, Muta, Genetis, Sterling Ultracold, Complion, RxQ Compounding, Script Anchor, Drop, Data Anchor, S4 Medical, and eFuse. Bill holds a bachelor's summa cum laude from Ohio State University and an MBA with high distinction from University of Michigan. You're all over the place, Bill. Sorry about that. Ernie Knight is a successful senior executive with experience spanning several decades, including information technology, financial services, healthcare, industrial manufacturing, and government. Ernie currently acts as the president and senior consultant with Knight & Associate, of boutique consulting firms that he founded to serve clients interested in development and implementation of growth strategies. His engagements are frequently with small and mid-sized businesses and early-stage companies, serving as interim executive management, CEO, COO, CFO, VP of Business Development, or leading projects in capital access and formation strategy, market research, M&A, business development, and strategic planning. Very pertinent to this panel, Ernie is the managing director of the Valley Growth Ventures, a micro venture capital fund focused on seed stage investments. Ernie received an MBA from Harvard Business School, where he focused on entrepreneurial finance, and a Bachelor of Science degree from Case Western University in electrical engineering and applied physics. Harry Friedberg from BX3 Capital, brings more than 3 decades of experience and knowledge in finance, where he spearheads the team's fundraising efforts. He launched his career at Drexel Berman Lambert, where he continued with such leading firms as AIG, Standard Chartered Bank, and Merrill Lynch. He's worked across the full gamut of financial products, including derivatives, foreign exchange, distressed debt, structured products. Harry has sold a wide variety of investment banking deals and introduced new equity-linked products to his client base. Harry is a season 7 and 63 licensed professional. He holds a BA in history from the University of Pennsylvania. In his spare time, Harry works extensively with a nonprofit organization, coaches his daughter's travel softball team, and is an avid poker player. So, gentlemen, welcome. Thank you very much for joining the panel. And make sure we have all 3 of you there.
Yeah, thanks for having us.
Thank you.
Absolutely. And so, typically when we're doing these roundtables, we've been doing them is just a back and forth conversation, trying to share sage pieces of information with the audience, with the group that we have in our audience here in our Ohio entrepreneurship community. So I'd really like each of you just to spend a minute or two, kind of telling me what brought you into venture capital. And so, Harry, since you're on the screen, we'll start with you.
What brought me into venture capital? Look, when you deal with professional finance, whether it's, bulge bracket, or even boutique shops, a lot of great financial professionals. And I find that their intelligence with all things finance is great, except for in that wide group that I've been around, they don't really think about all the, I'm going to call it cool stuff that entrepreneurs out there are doing. And so I often say that, I help articulate ideas, but I am constantly amazed every day by individuals, groups out there who are really forward thinking, tackling problems, thinking about products that I would have never thought of. And on top of that, all the folks around me in finance, they don't really think about that. So there's real problem solving out there that's done by, those venture folks, and they just need the help. They need the ability to connect, to articulate those visions, and to also understand how to organize it for folks in finance so that they can get that financial backing. And really that's what drew me to venture capital, to really help people articulate their ideas, fund their ideas, and get great things that I never thought of out there. And I think that finance needs to do more of that because there's tremendous entrepreneurs out there that just need a little bit of help.
Thanks so much, Harry. And so Bill, how about you? I mean, you had a Silicon Valley experience and then came back to Ohio. What drew you originally into venture capital?
I always liked the growth aspect of it. I thought two things. One is just innovation. I'm not an engineer by training, but always fascinated with the ideas people come up with. Just creating new industries, transforming existing industries. It just the level of creativity, innovation out there just amazes me. So I really just like looking at new stuff and figuring out what is doable and will kind of resound in the market and what won't. I've just always been intrigued and enjoy that. Always have enjoyed entrepreneurship, and such. And like I said, the big thing is about growth. I really don't fit in well if you're talking about, okay, we want to kind of maintain stability. We want to just kind of make sure the engines are running on time. That probably is not the environment for me. I love rapid growth, hiring new customers, figuring out how to get new customers. And the last thing I'll say, it's a little bit like, the old Bible story of David versus Goliath. I've always liked that story where, okay, this big company has all the money, all the engineers, all the customers, Can we leapfrog them, into the next generation, what we're doing, or can we create something that makes that irrelevant and creates a brand new industry that kind of absorbs that? So it's kind of, it's just been a good personal fit from those perspectives for me.
Listen, have a very, very storied experience and career doing it. So it sounds wonderful. So Ernie, what about you? You're kind of an executive who got into venture capital. What drew you to that?
Yeah. So if you look at my educational background, electrical engineer by trade with an MBA. So appealing to the electrical engineer part of me, innovation, science, really being on the cutting edge of technology. And the nice thing about venture capital, right, as opposed to focusing in one specific company, which is great, it allows you to see it broadly, right? You're seeing the latest and greatest new ideas and innovations. And the science and engineering me really appeals to that. On the other hand, right, business building. I love the challenge of building a business. And there's no greater business challenge than working with an early stage startup, helping them get their first customers, helping them think about market entry and commercialization strategies, helping new CEOs manage investors, manage the board. And that's just business building in its purest sense. So venture capital really allows me to engage on both sides of the fence, the cutting edge technology and the business building.
That's wonderful. So since we have you on, Ernie, what do you guys typically look for in Valley Growth for an investment? What industries do you look at? What funding cycle do you look at?
Sure. So funding cycle, we look at the seed stage, and what we define as the seed stage is the cusp of market entry. Ideally, it's a company that's got a handful of customers, maybe only a few. We will do pre-revenue, though we want a company to have at least an MVP or a beta. We want to be able to talk to customers that are, as we say, playing with the toys. So we really value that direct customer feedback, which kind of goes to what do we look for? We look for products that solve a real pain point, right? A must-have product. In terms of sector, we're pretty broad. We're focused in Ohio, so we have a wide range of geographies that includes software and IT, advanced materials, additive manufacturing, healthcare broadly, really anything except big pharma and drug development.
Wonderful. And so your focus is in Ohio. You're supported by the state of Ohio. Can you tell us a little bit about that?
Absolutely. So we are a $6.05 million micro VC, and I don't round down to 6 million. You're small like us. That last 50 grand means something. So 6.05 million. 3 million of that is provided from the state of Ohio through the Third Frontier in a really investor-friendly program. It basically gives our investors what amounts to 2-for-1 leverage on their equity, which is a really wonderful deal for investors. And I won't bore you with all the details of the exact financials, but it's a really, really good program, and the state of Ohio provides half our capital. And we're lucky that we have investors from across the country, not just from Ohio. We've got 11 states in total, all the way from Silicon Valley to New York and Boston, Florida, even an investor that lives in Canada. So we've got a pretty broad footprint of investors, but we're very proud of our engagement and our investment in the state of Ohio.
Wonderful. And so Bill, you're also Ohio focused, maybe a little bit bigger here. Can you tell us a little bit about OIF and really what the focus is, and why you joined from Silicon Valley? And so I know it's a leading question here, but we really wanted to know what brought you back from Silicon Valley after you tell us a little bit about OIF.
Yeah, so at OIF, like you had mentioned in the intro, both tech and med tech, years of service, cybersecurity, data science. Actually, Ernie and I are in Data Anchor together, also as well, which is a cybersecurity company here in Columbus. Also med tech, and we do some early stage biopharma, particularly a couple of cell and gene therapy biopharma deals with Nationwide Children's here locally. We're typically at the Series A level. So the company is probably approaching $1 million in revenue or so, and wants to scale to 10 million plus over the next couple of years. We do select seed stage. Data Anchor was a seed stage, and that's usually with we do one at a time because it's a lot of work. But that's usually with an exceptional entrepreneur, either a proven entrepreneur, which is a little bit rare in Ohio versus Silicon Valley, or an entrepreneur just with outstanding background, an idea. In this case of Data Anchor, it was Emery, who was a PhD from MIT, worked at Lincoln Labs there, computer science professor at Ohio State, had a breakthrough idea of embedding security into data, and just wanted to help him to build out the team and grow that. I had kept track of Ohio a little because I grew up in Cincinnati and actually invested a small amount in, it wasn't Ernie's fund, but a different, I didn't know Ernie until about a few years ago when I came back for OIF, but I had invested in another seed fund and just kind of kept track of, as a limited partner of the progress here. And I think maybe 10, 12 years ago, a lot of companies were like, you know what? I remember coming back and seeing the best company in Columbus that they had to offer. I think they're still called Tech Columbus versus Rev One. And I knew this was like data recovery as a service. And there are already like 15 companies in Silicon Valley that were launched and, $15, $50, $100 million in revenue. And this company had a piece of paper to do the exact same thing. But I started looking at things more in the 2014, 2015 timeframe. And it seemed like some of the software companies, a little bit on the, now clearly a little bit more Nationwide Children's cell and gene therapy, but things were starting to look not as many companies, but starting to look more like what I was accustomed to in Silicon Valley. And but for a lack of capital, and then particularly a lack of expertise and kind of investor to partner with you, they probably weren't reaching their potential. So kind of came back and said, I think there's enough here. I didn't know at first. I mean, I literally for the first year didn't have a website as I was trying to just get off the ground, make contacts, and really figure out, did Ohio have, enough to really build up something substantial? And luckily, it does. And so I'm, kind of thrilled to be back and doing that. And the other piece is, Ohio Innovation Fund's kind of a startup within the venture group. So I had already had a pretty good group out there. There's guys like Drew Perkins out there now at Mojo Vision. I'd done Infinera with him, so I've done a few deals with him and other people. A guy named Gus who sold Blue Arc for $800 million, then a year later sold another company. And so it was kind of a more stable, kind of like investing in the same groups again and again. This was a little bit more exciting to really, kind of come back to my home state and kind of get off the ground and actually start a startup VC with funding startups. So it's kind of some excitement for me personally as a quote unquote entrepreneur, starting this venture firm. And I've really enjoyed it.
Listen, I think you're spot on given the time I spent here and Ernie spent here. I think around 2015, 2016 is really where you saw that swing, right? You saw a lot more support from the state. You saw a lot more interest from VC out externally with Drive and other folks. And so I think that we're finally reached a tipping point, as it were, right?
Yep.
So Harry, on that same vein, you're an out-of-stater, you're an East Coaster. What do you see in Ohio? So you're a new, fresh perspective. Bill and Ernie and I have been around here for a while. What do you see from the East Coast when you look at Ohio?
Don't hold the East Coast thing against me. It could be worse. Look, I think that it's really interesting, and Eric, you know about this about me when we first met, where I'll call it the hubris of both the East Coast and the West Coast, where my managing partner, Mike Minahan, says, hey, I want you to go out to Columbus. You're going to meet this VC group, and then you're going to meet these great innovators and all these folks. And, when you live in New York, which I used to at the time, I now live in Montclair, New Jersey. But you're like, really? Columbus, Ohio, really? And then, I think it's the same, and Bill probably can back me up. I think he's already said that when you come from the West Coast, right? You're in Silicon Valley, between New York and Silicon Valley. Well, is there anything in between? No. But in fact, I was really, really just taken aback by how much innovation is going on in Ohio and how many both great companies and really interesting VC partners exist within sort of that whole Ohio ecosystem. And shame on me and shame on everyone from both coasts who has that hubris and doesn't really dig deep into what's going on, because Ohio's doing some great things. The non-dilutive capital, which, you educated me on the full workings and acquisition of that. But there's, for lack of a better way of putting it, there's some really great stuff that's going on that people on a plane just fly over, look down and go, oh, isn't that nice? And that's their loss. I joined BX3 May of 2019. We flew out for the first time to Columbus August of that year. And gosh, what I would have missed if Mike Minahan hadn't prodded me to go out and really take a look. And we found some great founders. We've found some great VC partners. We're, currently finalizing a $20 million deal with someone who's actually, in the Ohio area. So, that's a pretty nice deal. And it's with a $16 billion private equity group from New York who didn't even know that this opportunity existed until I brought it to them. And they're like, holy crud, we got to go and do that. Let's find out more. And so shame on them for being that hubris on the East Coast that they didn't go and dig across the United States, but instead East Coast and West Coast. So, that's what I see in Ohio and particularly Columbus as well.
No, thank you, Harry. So we're going to try to give a little bit more focus on some of our entrepreneurs here and ask some questions that they might typically have of you guys. So we'll start, with Ernie here. When you're looking at, investing in these new early stage companies, what are your main criterias and what do the capital structures typically look like for you and maybe the organization of the company?
Sure. So, in terms of structure, for tax reasons that I don't want to bore everybody with, we really have to have C corporations. Now, we will invest in convertible note instruments to fund companies that are LLCs, but it would have to have a provision that would state before it converted to equity, the company would convert to a C corp. And it has to do with the way our our investors are structured and whatnot. But we have to have a C corp structure for investment. In terms of criteria, first you're always looking at team, right? Is the entrepreneur? Do you believe that entrepreneur can scale a business? Can you work with them? I like to think of investing is very much like a marriage, right? You're going to, especially at the early stages, you're working hand in hand with the entrepreneur and the team. So entrepreneur and team. And I mentioned this a little bit before. We look for products that customers say are a must-have. They solve a real pain point. And we often look to validation from sort of name brand organizations. For example, you've got a partnership agreement with Siemens or a beta with IBM, and I'm being a little bit dramatic for effect. We look for validation, and we look for opportunities that solve a big pain point and a must-have. And we need large markets, right? We need to be able to have line of sight to a company that can grow into a $500 million or more company. But really, we're thinking about solving pain points and a strong team that we believe we can work with and scale.
Wonderful. And so given that you're focused on seed or pre-seed, Ernie, let's ask Bill how the same question, but how it applies to a Series A level company. I mean, is it still based off team, or is it more based off market and market potential? What are you seeing for that, Bill?
Well, it's a little bit different in Ohio than it is elsewhere, because there aren't as many teams that have been through successful IPOs or M&A. We do have one down in Able Injections in Cincinnati, Mike Hooven, who had taken AtriCure public and now is doing Able Injections, and a little bit with Script Drop with Amanda, who was an early employee at Cover on Meds. But for the most part, you're usually dealing with like a Complion, Rick, who kind of was frustrated with clinical trials and created software to help handle that, or Jeff Schuman at Aware here in Columbus, who was frustrated trying to roll out Yammer and Microsoft Teams around security and compliance at his big company, and said, hey, we need a security compliance, software, cybersecurity product for that. So usually the team isn't quite as proven from that perspective, but they clearly have, as Ernie said earlier, there's that kind of must-have versus nice-to-have aspect of the product, and they really have a good understanding of that. And they have a good background from a business and or technical perspective to solve that we can then build around. And we're obviously looking with the end in mind, as Ernie mentioned too, with partners. It's very important. Strategic partners really help. In some cases, like in Able Injection, Sanofi led the Series B. They have a pharma company with a huge balance sheet, so that can be helpful. But even more so from a business partnership perspective, they can help scale quicker than you could otherwise. And the other piece is they're the likely acquirers down the road. So we always kind of have that in mind. We're looking for kind of innovative ideas in the core markets. The markets usually have to be at least starting to approach $1 billion, because if they get a little bit too small as far as potential market size, then acquisition-wise, it becomes difficult. And the last thing I'd say on that is we always like to think of, okay, if we're sitting across the table from an acquirer, and they say, a lot of times they say this, oh, well, we're thinking of buying you, or thinking about doing this ourselves. I'd love to just be able to laugh at them and say, I mean, my classic example is back in Silicon Valley, Infinera, they combined 300 networking components on the chip the size of a fingernail with some great people. It's like, you try and do that yourself. So that's not always the case in software, but hopefully you have a big enough customer base and lead that, okay, by the time you catch up and try, and we're locked in. But we try and do that. And the last thing I'll say on that is, I've been proud of some of our companies, like for example, Sterling Ultracold down in Athens, because one of the great worries they had early on was, well, what happens if we're acquired? Does this get moved? And there's like, okay, well, who would acquire us? It's almost like, what's going to happen to us? I think part of it for Ohio companies is saying, and that's something that internally we're saying now. We brought a fellow Dusty from Boston actually in, who had run a public company, grew from 65 to 35 million, Brooks Automation in this area. He's like, well, if we're world class, they're going to want to keep it. They're going to want to keep the team and everything else. So we're really focused on a team that does want to build something world class here, because it's, well, Cardinal's a partner, a couple of our companies and stuff like that. It's nice to have local partners like Cardinal. We take a lot of pride in national, international partners and say, hey, with your 20 companies here in Ohio, we want to partner with those companies because we think that you are doing something impactful in the industry on a global basis. So that's really the type of companies we're looking for, an exit potential of at least $100 or a few $100 million. We know that in Ohio, every deal can't be a Google or a Facebook or what have you. But some of them, like Enable and others, can be worth $1 billion or more. But a lot, there's probably a sweet spot there of 100 to 250, some up to 500 such in the cyber data science area, some of those areas in med tech. Same with the stuff coming out of Nationwide Children's. I know MyoNexus sold for, I think all in 300. So that's kind of what we're looking at.
Well, and you see Roots IPO at $6 billion, and you're seeing a lot more potential than you saw just 2 or 3 years ago, right?
Yep, absolutely.
So what do you guys, we'll stick with you. What do you typically expect in terms of actual returns? So you say that sweet spot is a $150, $200 million exit for you guys. What's that in terms of return for the fund?
I mean, that would be, I like to be higher than that. I'm just saying that's kind of at a minimum 100 plus. We like to do 3 to 5x the fund, so we need the early, the Series A to do 10, 15, 20 times. I mean, hopefully one of those deals returns the fund or multiples of the fund. As you get a little bit later, that scales down to 5 to 7, and very late stage, 3 to 5x. But not all of them fit this, but most of them we want, we want to have at least a good shot at a Series A having a 10x return. Should it be successful? Hopefully more.
Right. Thanks so much, Bill. And Harry, will ask you the same question in terms of expected returns. So when you're looking at it from the East Coast perspective, where are the expectations on return, and maybe how do Ohio companies line up against those?
Well, first of all, when I speak about the returns, I speak about, the companies that I'm currently representing. But I think that when you talk about East Coast, and again, not to pick on Bill, but he'll back me up on the valuations in Silicon Valley. The valuations in the East Coast are just so much higher than, and it's starting to catch up, and then it's so much higher than you're seeing in Ohio. And that difference represents opportunity. And that's what I try and highlight when representing sort of Ohio-based companies, saying, if you were talking to someone who's over in the New York area, right, you'd be looking at a very different valuation. You'd be looking at a very different ownership stake. Generally, I tend to stop at sort of Series A/B readiness. That's my sweet spot, trying to marry investors with the projects I represent. And being 100% honest, when I first joined BX3, marrying those two things, this is my, whatever hundreds of investors with, these are the projects that I really, really like and want BX3 to represent. It wasn't always the perfect marriage. And so I'm trying to balance that. But I still think when you look at Series A, you're looking at sort of starting with someone who's getting a seed stage and saying a valuation of, let's call it 1 million, 2 million, 3 million. Now we're moving past that cocktail napkin, but they've got a real thing and they're hoping to progress it along to Series A readiness. I think you have every expectation that you're supposed to get, from a 2 or 3 million valuation to somewhere around 20 million, 15 to 20 million by the time you get to Series A readiness. I've seen, I've had one company that was trying to raise 16 on a 50 million valuation. And it's like, the question asked of me is, Harry, where do you think this thing can go? And it doesn't matter what pie in the sky. you're still talking, excuse me, well, I'm trying to raise 16 on 50 in your Series A. What can I do in B? What can I do in C? And I think that was a real turnoff, if you will, for the investor base. And it was a learning experience for the founders.
Hey, thanks so much, Harry. So Ernie, we're going to slide back into the seed and pre-seed here a little bit. To Harry's, $2-3 million on the back of a napkin. What financials do you expect from these early stage, pre-seed companies, Ernie, to do your diligence for investment?
Yeah. So, to the extent they have, they're going to have some historical financials. So we're going to look pretty, deep at those. There's going to be some learnings, but primarily, we're focused on, working with the company to develop a financial model, right? And typically the financial models that we'll see at the first pass are, they need some help to get us comfortable with an investment. So deals that we do, we will typically dig in and work hand in hand with the entrepreneur to see if we can get a set of projections and a financial model that we're mutually comfortable with. I mentioned the marriage, right? It has to go both ways. It has to be a good partnership. But we focus certainly on the time frame of the capital that we're raising, but we also like to think even at the seed stage on a 5-year model, because we're not going to have our exit in year 1. We're going to have our exit down the road. We want to make sure that this understanding that it's not going to be accurate 5 years out. We can at least talk about the assumptions, key drivers, how much capital you're going to need to grow over time as you scale, because you don't want to have any major surprises on the back end. So, for the seed stage startups, we look at a little bit of history, but we're really focused on how can we figure out a go forward model that we mutually think can work.
Does that leverage funding from the state of Ohio give you the ability to lower your expectations on returns or take additional risk, or does it do anything else to influence your investor base?
So that's a great question. Certainly, here's the reason my hesitation. The short answer is it could, right? And I think
the right answer is that maybe it shouldn't, right?
Very strong argument that makes sense. We don't view it that way. We view the leverage from the state as, we're in a really risky stage, right? The seed stage, and we're geographically restricted to Ohio. So, Ohio's got all the positives we talked about, but it's still a restriction, right? So that limits our deal flow set, right? It limits us on a couple of things. The risk mitigator for that is the state's leverage. So from our perspective, it doesn't lower the bar. It's a needed and helpful risk mitigator, but the bar is the absolute same. I don't think about taking extra risks because of the state leverage. I view that as the risk mitigator for the geographic restriction.
Fair enough. And so Bill, taking one of Ernie's companies and looking at it for your Series A funding in OIF, what financials do you require? What do you need to see to really vet this investment? So these are for companies that are like you said, hitting your 1 million in sales a year.
Yeah. Usually at that point, obviously, the historical financials and then projections. But then we're looking more for starting to be bottoms up versus top down forecasting. Because I think initially there's a little bit of tops down in terms of what we think in general we could accomplish, and you try and say, okay, what's the average ASP and what's the average number of customers and all that, but still a little bit of a swag and directional. As it starts to get to this stage, you're looking at specifically okay, what number of customers do you want to hit? How does the pipeline look? How does the coverage ratio look? Those sorts of things. So there's just a different discussion at seed stage in terms of trying to find product market fit and trying to find the right messaging and all that and the right target focus by industry to if we want to do a few $1 million this year, $2-3 million this year, you want to have 4x coverage. So where's the maybe starting at 6 but eventually $8 to $12 million type pipeline to So if you close a fourth of that, you kind of hit your you hit your number for the year. So just a different level of stage. And you see, different types of people at different stages. A lot earlier stage, you have a lot more former entrepreneurs and people with technical backgrounds. At our stage, that's that, but more of a mix, a lot more product people as well. And then in later stage, you get to where basically, once you're up to 20 million plus, it's almost like it's not a public company, but it's somewhat closer to that in terms of, okay, you hear your monthly, obviously your quarterly number, how's that compare to plan? What's the variance on margin? You look salesperson by salesperson. We have 5 of them. Who's on plan, who's off a plan, how many quarters have been on and off plan, trends, all that type of stuff. So it's a continuum where you keep learning and learning, but process and formality is the wrong word, but process and kind of a more strict discipline and review, because you have much more data to go on, keeps expanding from that perspective.
Gotcha. And you mentioned, obviously in your bio, but you also mentioned that you serve on the boards of quite a few of these companies. Does OIF take an active position in every one of the investments? And then how much interaction do you have with management, or oversight do you have on management on your investments?
Yeah, we take a pretty active position. It depends on basically the fund is myself, and then Faith Voinovich, she's a principal, just MedTech and Life Sciences. We also have Mike Hughes, who is a venture advisor, venture partner from Silicon Valley. He's actually on the board of Data Anchor with us and on advisory board of Aware. He was actually the senior vice president of worldwide sales at Barracuda, and now is charge point, which I think has announced a public filing a couple $2 billion. So, either ourselves or one of our advisors will be very active, with the companies, because they need that help. I mean, probably in a projection, kind of, you have someone like Mike Hooven there, who's kind of already taken a company public, but most of the time it's pretty hands-on, where the interaction will be at least once, not a couple of times a week, and in some cases 3 to 5 times a week, just depends on the time.
Thanks, Bill. So Ernie, for you, since you're a smaller fund, you obviously don't have nearly as large a management fees as what Bill has. Do you guys take a less active role, or how do you mitigate that engagement with your investments?
So the way we don't take a less active role. We are very active in our deals. We always take a board seat or a board of observation role. Usually that's me. Sometimes we'll pull in members of our advisory board or our investor base. We're fortunate, as I mentioned, to have a national investor base. So we have lots of resources we can tap. But to your point, we are a small fund. We do have some strategic investors that help. Those include the Youngstown Business Incubator, Energy Innovators, the Energy Industry Incubator in Warren, Youngstown State University, a group called Valley Partners out of Youngstown, and Bon Secours Mercy Health. We leverage them quite a bit to augment us as a small fund, kind of do more with less type of thing. But we are thinly resourced with a small management fee, but we really work hard to creatively utilize our partners, and we take very active roles in all of our investments.
And I knew you did, Ernie. That was a softball question for you. And so Harry, let me ask you, kind of looking at this from a little bit of later stage of funding, what do you guys typically think of angel investment groups or angel investors, and how does that play into your decision on taking the next round of investments?
It's kind of tricky. One, because my sweet spot is not angel investors.
Right.
And so my experience with them over 32 years is limited, more so in the last probably 2 years. And I think that angel investors in general can be a great resource. Very often, there's a completely different vetting process that is done by them, for better or worse, might I add. And if you stumble across, and I have to say it that way from my perspective, but if you stumble across the right group, it can be very helpful for the right founders. I've seen the good and bad with some of the fundraising that I've done, where angel investors have been instrumental in getting a group off the ground, whatever the company was. I unfortunately have seen one instance where it ended up in litigation, and it was eventually resolved, but you've heard me use the expression, it was a little bit of bad guy stuff. And so, I rely on my network. I rely on the folks that I know. And, the private equity group that says, hey, Harry, I want you to talk to this guy. He's in the VC world now that could help you. And this seems like an ideal project for him. That's something that I feel more comfortable with than some of these angel groups. Although I've been on any number of panels and watched, pitch competitions where I think that it's been very helpful to the founders. So far be it for me to sit there and put anyone off of that. I'm just giving you my sort of good and bad experience.
Now, listen, we'll take any insight you can provide, Harry. And so I'm going to ask Bill though too, because Bill, you probably have had some of your companies in LIF come up and be funded either by angel groups or individual angels. How does that influence your decision to take investment? Do you recommend angels? What are your general thoughts about angels in early stage companies?
Well, yeah, I've enjoyed working with with Ernie, obviously, and so I've tried to develop relationships, as you had mentioned, few of them that I think are doing things the right way, and that's if one of the things that does happen over time, though, is if you have quite a few angels involved, and you end up having board situations where you have 6, 8, 10 people at very that those types of things. I have seen, as was mentioned earlier, I've the good and the bad. Luckily with someone like Ernie, it's been the good in terms of him rolling up his sleeves and working with the companies and asking them questions and all that. I've also seen the bad where this COVID, a few individuals are like just trying to score earlier than might be otherwise advisable, doing quite fine. So
okay, well, thanks for your insight, Bill. Let me ask you guys. We're gonna wrap up here shortly, but we're gonna talk a little bit about some of your bigger successes and failures. So, this is again sharing with the community. We want to convey to these entrepreneurs and startups that some of them are going to succeed greatly, and some of them may fail miserably, and that's okay. Get all back on the horse and try it again. But we'll start with you, Ernie. What's your biggest success to date in investing?
Sure. So, right, wrong, or indifferent, right? And investing is pretty easy to keep score, and you keep score based on exits and returns. So, we're a new fund at Valley Growth Ventures, so you have to go to previously I co-managed Nationwide Insurance's venture capital fund, and led an investment in Lombardi Software, which was a business process management software company in Austin, Texas. They sold for close to $200 million to IBM, and generated a pretty nice return for Nationwide and for us as a company, as a firm. I have to say, right, that the best successes a lot of times tend to have the least work. We had a rock star management team, and for the most part, we gave some advice and a lot of cheerleading, and the team and the broader investor group did the heavy lifting. But very proud of that exit, and the numbers are what it is. That's my biggest success personally in the venture business.
So what do you think about the other side of the coin? The most money dumped into the biggest loser. And again, not specifics, but I mean, try to give our audience a little bit of sense to the fact that sometimes it happens.
Sure. So, I still have a great affection for the group that was involved in this. So I wouldn't frame it as the biggest loser, though it would be, technically correct. Worked with a company in Dallas, Texas. The name of the company was Metalec, another enterprise software company. And we invested with Apex Venture Partners, TL Ventures, SAP Ventures, put $8 million into a B round. And we made a significant lesson learned. We hired a full-blown VP of sales, management team, sales team, really based on 2 quarters of success, and assumed that was repeatable. Was not repeatable. And, we didn't get much growth out of that, and we increased our burn in a big way. And by the time, we started to make the adjustments we needed to make, the writing was on the wall. So the lesson learned was, before you build up the sales and marketing infrastructure, make sure that you've, got that product market fit, and you're confident in that scalable sales and marketing model, right? A little bit of, crawl, walk, run, as opposed to crawl, sprint. But we lost, we had an exit. It was in a fire sale. So it was, it was not pretty, but that would be our, my personal, I led that deal and served on the board for a number of years. So that's the biggest failure in my book.
Well, listen, Ernie, we appreciate you sharing it. Again, there are lots of great success stories, but the failures are the ones we learn from, right?
Absolutely.
And so how about you, Bill? We'll say either West Coast or Ohio or both. Biggest successes and failures you've had to date.
Yeah, I'll start on the well, I'll call it the failure side, but there's a company called Zia Laser, which was did what was called quantum dot-based lasers.
Oh yeah.
Which basically is a cool technology. Is actually out of University of Mexico and Sandia Labs. Luke Lester, who's an expert on that, was the founder, and it just had this wide tunability and all these characteristics that were just phenomenal. But this was going into the telecom meltdown of a little bit earlier, a while back, and we actually did the Series A. Things were going great. Brought Venrock in the Series B. The technology worked, and then just the market went away. And so that was, we had even the founder of Wellfleet was involved with that. That Wellfleet was one of the 2 major router companies initially, along with Cisco, became Bay Networks. So there's been stuff like that. Another YY Software was some linguistics team out of Stanford trying to do some stuff pre-Google. Couldn't quite get reliable enough, so the product just kind of never worked fully. That stuff happens when you're kind of swinging for the fences or swinging. It just that's inevitable. And what have you. I don't like to publicly state like, hey, this company versus that company versus the other.
Sure.
On the other side. But I think on the for myself on the med tech side, that stuff, although I'm not as much of med tech that I can like tangibly see the benefits of. You take a Dexcom and a continuous glucose monitor and know how many diabetics use Dexcom to monitor their diabetes. Seeing that out there is phenomenal. Obviously, its market cap is phenomenal. But love the fellows Drew and Jagdeep and those guys at Infinera. Now Drew's over at Mojo Vision doing some cool AR VR stuff and all that. And so that's there's each one is different. But I've enjoyed probably Dexcom and Infinera have been the two of the bigger ones out there. And I see a lot of promise here in Ohio. I could see, whether it's enable injections, whether it's, script drop, whether it's Strong Ultracold or other companies, a lot of interesting data science, cyber companies like Aware, Data Anchor, Muta here in town. There's a lot going up in Cleveland, compliance, enable. There's a lot of neat stuff going here. They won't all be IPOs. Some of them I mentioned earlier probably could be or will be, and some later ones may be meaningful acquisitions. And the thing I really can't wait to see is like you take a company, eFuse in the esports and e-gaming area or whatever, or Aware with Jeff, where you had founders that came out of OU or Ohio State. They're relatively younger, and they go and sell something for a few $100 million, and they own 10, 20, 30% of those companies, and they're walking around with $100 million. That is, you talk about getting people like motivated to do startups. And just a number of startups, as we start having success, will come out of that. I think ultimately, hopefully, I look back as that in Ohio being the biggest win that, because until, once those people do that and are giving huge donations to universities and just are, it's no longer someone doing warehouses or retail or insurance that are the biggest players only in Ohio. It's someone that did a tech startup or a med tech startup or cell and gene therapy startup. That's really going to change, I think, the culture and mindset of our state, even more so. Like you're talking earlier, it's really gotten better over the last 5-10 years, but I'll just take it the next order of magnitude up.
Yeah, now your angel community changes significantly when you have a bunch of 30-year-olds running around with $100 million exits, right?
Yeah.
And so final wrap up. We're a little over here, but Harry, what would you recommend for our startup companies as the three most critical things to consider before approaching venture capital groups?
Well, see, and I don't even get to say my success stories.
Oh, well, listen, tell us your success stories, Harry.
I was all set to answer that one, and then you can ask the next question, because there's actually something to be learned from what I was thinking. Because one of my biggest successes was also the biggest failure. But I also want to follow it up with a interesting success story, which will go to your next question. So kind of mid-90s when I was living over in Hong Kong, and this is why I struggle with consumer products companies generally. Friend of mine back in the craft brewing era, when it was all starting to take off, best beer ever. Literally everyone who tried it loved it. And before I was thinking, hey, I'm an angel investor, I'm a seed investor, I'm just one of those accredited investor schmucks who said, I'm going to get a group of folks together and we're going to support this product. And we did. And simple structure, didn't really think about it, even though I was in well advised on fixed income, simple, just equity investment. And we were very fortunate enough that he hooked up with a big brewing company, and my probably 40 cents a share or whatever went public at about $6.50. So I turned $75,000 into probably about 650 on the IPO. So as everyone's feeling all good, wait for it. This is about be careful who you get in bed with. That brewing company, the CFO embezzled, ran off with all the money, and we went from $6.50 to zero before my lockup period was done, and they filed for bankruptcy within 6 months. So, it is very careful. I know Ernie and Bill have both said it, whether it's founders, whether it's team, whether it's who you advance down that road with, you have to pick those people very carefully at every stage. And then part two of that is a recent success story, and I'll call it that. Eric, you're probably a little bit aware of this. We had, before we were ready to go to market with one of our capital raises, we had a nice meeting with someone who, ideal partner, right? And for whatever reason, in between December and March, we lost touch. We couldn't quite come to, an agreement on how we would operate together. We go and have a marketing deck put together. Haven't spoken to this guy for months. And I sent him the marketing deck. And my managing partner says to me, I wouldn't have even bothered. Why'd you bother? And lo and behold, we fast forward to, hey, if you still have this open, this would be fabulous for us. You're a perfect fit. And, we're talking about a $10 million commitment. So the lesson to be learned for everyone out there is capital raising is diabolically difficult. It's a 24/7. You got to stay with it. Don't write people off. Always be professional. And you never know when that thing is going to resonate. That relationship is going to pay off, which is why I still speak to people from 32 years ago.
I think that's probably the best piece of advice to wrap this roundtable up on. So Harry, thank you so much. Bill, Ernie, thank you guys. We very much appreciate you being part of the panel and Startup Week in general. The video will be archived. People have your contact information, and I think you get free T-shirts. So, I mean, what else could you ask for?
Excellent. Thanks so much. Enjoyed it.
Hey,
All
thanks.
right.
And I wear a large.
Listen, we'll make sure you guys get them. Thank you so much.
All right, see you. All right, bye.
Have a good one.